Hello, good day, good afternoon, and welcome everyone to the training session. It's great to have lots of you joining us already. Since we had lots of you in the waiting room, we thought we'd let you into the session before we get started. So please feel free to say hello and introduce yourself in the chat if you'd like to, as we're waiting to get started. Perhaps let us know what organization you're joining us from today. It'd be great to know who we've got in the room with us and your interest in this topic. We've got a very packed agenda for our session today, so I think without further ado, I'll kick off the introductions from our side. So, as I've said, big hello and welcome. My name is Fiona Quinlan Wells. I'm a member of the SSE Academy team. It's a pleasure to be here with you for today's training workshop. So, this training is really designed to be practical and relevant, whether you're new to this topic or perhaps it's something you're already exploring it. And our goal really is simple. We hope that by the end, you'll feel really much more confident about what you need to do to prepare yourself to oversee sustainability disclosure using the ISSB standards. So, firstly, before we dive in, I'd like to say a big thank you to all of our partners who've helped to make this workshop possible, particularly to the IFC and the World Bank's SDG Partnership Fund for providing financial support for this project, and of course to the team at the Egyptian Exchange for hosting us today as well. So without further ado, I'm very pleased to let you all know that we're joined today by Omar Radwan, the incoming chairman of EGX. And so it's a great pleasure to have you with us today, Omar. And I'll pass over to you now for your
Thank you
opening.
very much.
Thank you.
Well, ladies and gentlemen, distinguished board chairs, directors, and senior executives, good afternoon, good morning, and good evening, depending on where you are, and a very warm welcome to the Egyptian Exchange Interactive Workshop on Board Oversight of ISSB-Aligned Reporting. It is my great pleasure to open this important session, organized by the Egyptian Exchange in partnership with the United Nations Sustainable Stock Exchanges Initiative. Since 2012, the Egyptian Exchange has been a proud founding signatory of the UNSSE initiative, standing alongside Brazil, South Africa, Turkey, and NASDAQ USA as one of the original 5 founding partners. For 14 years, we have enjoyed a strong and continuous strategic partnership with the UNSSE. We remain deeply committed to this collaboration and to enhancing the capacities and capabilities of the Egyptian capital market. Our leadership in sustainability remains strong and forward-looking. In 2024, EGX was the first exchange in the world to host the high-level event Gender Equality and Global Markets. Today, we are once again pioneering as the first exchange in the region to organize this specialized board and C-level training on ISSB-aligned reporting. This workshop is part of a comprehensive capacity building series. We will follow it with a dedicated training for practitioners and the workshop on the Task Force on Nature-Related Financial Disclosures, TNFD. These initiatives demonstrate our firm commitment to supporting our listed companies at every level, from the boardroom to operational execution. Ladies and gentlemen, the global direction is clear. In 2023, the International Organization of Securities Commissions, IOSCO, endorsed the IFRS Sustainability Disclosure Standards, IFRS S1 and IFRS S2. Here in Egypt, the Financial Regulatory Authority, the FRA, is actively preparing for the adoption of these standards very soon. In this new reality, effective board oversight of sustainability-related risks and opportunities is no longer a choice. It is a fundamental responsibility that directly impacts strategy, risk management, governance, and long-term value creation. And this is exactly why we are here today. I strongly encourage you to engage fully, ask questions, share experiences, and cascade the knowledge you gain to your fellow board members. Companies that act early will transform these requirements into a real competitive advantage with investors. Before I conclude, I would like to express our sincere gratitude to the UNSSE initiative team and all our expert partners for their continued support and excellent collaboration. We look forward to many more joint initiatives that advance sustainable finance across the world. Thank you very much and wish you all a highly productive, insightful, and interactive session. Good luck.
Many thanks, Omar. Thank you so much for setting the scene so well for us. And yes, a big congratulations and thank you to EGX for their ongoing partnership on this initiative. As you say, the first exchange to host this new training program. So we really appreciate you taking that step to be the first ones to host this in the market. And we're sure it's going to be a really interesting session today. So thanks again to all of the team at EGX.
Thank you and good luck.
Great. So now I'll introduce a few other faces that are going to be joining you today for the training. So as I've mentioned, I'm Fiona and I'll be co-facilitating our training today together with the head of the SSE Academy, Tiffany Grabsky, as well. Hi, Tiffany. We're very pleased alongside us to have a number of experts joining us today. So firstly, we have Robert Swiatowski from the IFRS Foundation. Hi to Robert. And I see Ndidi has just joined us as well. So Ndidi, thank you so much for being here too. Ndidi is a member of the ISSB board and she'll be joining us to contribute to our Q&A session at the end. So do make sure to save, well, you can ask your questions as we go, but we'll have time to cover some of those together at the end of the workshop too. We're also very pleased to be joined by our colleagues today from the Chapter Zero Alliance. So firstly, a big welcome to Simon, the Program Director of the Financial Sector Program at the Chapter Zero Alliance. And we'll also be joined today by Simon's colleague, Ayman Salah, who is the founder and CEO of Chapter Zero Egypt as well. Hello to you, Ayman. Great to have you here as well. And he'll be available to support in the chat and Q&A too to share some more details with you about how you can get involved with the Egyptian local chapter as well. So it's really great, of course, to have such a fantastic group of facilitators here with us today. So please do make the most of that opportunity during our live session today to ask your questions of our facilitators. So we'll have a 1.5 hour live training workshop, and we'll also have an extra 15 minutes at the end of the session where we'll be all available to ask extra questions. So do please feel free to join us for that if you have extra questions, although that part of the training is an optional part. But as I've mentioned, you can ask your questions throughout the training in the Q&A box as well. So we'd really encourage and expect, if we can, your participation in our session today as well. So we're going to be using the chat and the Zoom polls a number of times for some interactive exercises. So we really encourage you to take part in those as well. And finally, we'll be giving out certificates for participation for engaging in our training today as well. So in order to get your certificate, you'll need to fill out the feedback survey, and we're going to share the instructions about how to do that at the end of the program with you. Sorry, you'll have to excuse, I'm getting a bit of background noise, but I hope it's not coming through too loudly for you. So just a few practical housekeeping points to keep in mind. As I've mentioned, we have a couple of different ways to interact with us today. So firstly, you can use that chat box as you're already doing now to share any general introductions or comments with the team as we move through the session. So great to see a number of you already making use of that. And you can also use the Q&A box as well to ask your questions of the team. So in particular, if you have a question, we'd really encourage you to put that in the Q&A. That will just allow us to track and respond to your question directly there. And so from our training today, we've got a number of kind of key areas that we're hoping to help you move forward with and understand today. So firstly, we'd like to help you build a clear understanding of the role of the board in overseeing ISSB-aligned reporting. So thinking about what that oversight really looks like in practice. Secondly, we'd like to help you to update the way that you think about risk management practices in light of these sustainability-related disclosure requirements. Then we'd want to help you to think about how you can build the right governance processes to be fit for purpose, really, for this new landscape. And finally, we hope this will be one that's quite immediately practicable. We want to help you to feel equipped to challenge sustainability data when it's presented to you. So boards don't necessarily need to be the technical experts, of course, but they do need to know how to ask the right questions. And that's really what we're aiming to help you with today. And so to help us achieve these goals, we're going to be working with our recently launched model guidance on this topic today. So this is a really key resource that we're going to come back to a number of times. And it's written as a template for stock exchanges to develop bespoke guidance for their markets. But we also hope that it can be a really practical tool for board members themselves. So you can find that guidance by following the link that's been shared in the chat. Or if you go to the webpage for today's event, you'll also find that as a resource on the slides there. It's also worth saying our slide presentation we're sharing with you now is available to download from that same location as well. And so inside that document, you'll find a four-step framework, which we really hope can serve as a checklist to help boards with different steps and actions that they can take across the four areas we're going to be talking about today. So we'll work through the structure of this in the workshop, but we really encourage you to take a look at this resource and come back to it to understand these areas in more detail. And so that brings me just to cover the structure then of our workshop, which follows that four-step framework. So these four steps are understand, align, oversee, and communicate. And these are really the four areas where boards can most meaningfully strengthen their role in sustainability reporting. So as mentioned, we're going to take a look through these areas together and talk about the actions from that checklist resource that align with these different steps. And so we've got a number of different tools and frameworks that we're working with in our training today, which we'll come back to. So this is just to say that all of these can be really used in a complementary fashion. So this diagram you're seeing here comes from our model guidance, and it really shows you how those four areas of our guidance that we're going to be working through align with the different areas from our other partner organizations. So firstly, we've got the guiding principles on nature and climate from the Chapter Zero Alliance, Deloitte, and the World Economic Forum, which are really designed as a tool for board members to enhance their oversight of nature and climate. And so Simon from Chapter Zero Alliance is going to talk us through some of the key principles there that can be used to help get you started on this topic. And then we've also mapped these aspects to the different disclosure content areas required by the ISSB standards. So you'll also want to think about drawing on these when you're making an assessment. So for example, in step one, you could make use of the disclosure content area that meets the ISSB standards relating to strategy. Of course, this doesn't mean that you should only look at these particular areas of disclosure or discuss management at this step, but it's just a useful starting point. And then finally, we have also mapped these steps to the IFC's corporate governance parameters. And so you can also use the IFC's corporate governance matrix to help you enhance your governance practices as well. So we're going to go into more detail about all of these areas in our course today, but this is just to say you can come back and refer to this resource, which shows how they all link together. Okay, so just to get us started, it'd be good to get a sense from everyone here as to how comfortable you are currently with your role as a board member in terms of reviewing reports. So let me just launch the poll for you now. So on a scale of 0 to 10, with 0 being low or not ready at all, and 10 being very high or ready already, how would you rate your current understanding and readiness to effectively oversee ISSB disclosures? So perhaps think here, if you were to receive an annual report from your executive team tomorrow, and you were going to be asked to provide comments specifically on the sustainability related financial disclosures, how comfortable would you feel reviewing this report and then perhaps signing off on it for public disclosure, particularly when you're thinking about perhaps requirements such as the ISSB standards, which might now affect your report? So let's see, we've got about 20% of you taking part in the poll so far. It'd be great to have a few more responses, but I see from the responses we've had so far, we've got a real range, I think it's fair to say. So let's just end the poll and I'll share the results with you there so we can see a good spread of understanding, but perhaps the most common being somewhere between 5 and 7 out of 10 at the moment. So good to know maybe there's a baseline there, and feel free to share with us in the comments as well any perspectives you have on this topic from your own experiences as we move through our training today. Okay, great. With that, that's our introduction covered, and I'll pass you over to Tiffany now, who'll start us on module one.
Great. Thanks so much, Fiona. And hello, everyone. A real pleasure to be here with you today. And a big thank you to EGX for making this workshop happen today. We're going to dive straight into the first step, which is our understand step. And this is understanding how sustainability affects strategic decisions. As such, when going through this step, you may wish to draw on disclosure content related to strategy And you can use the ISSB standards required disclosures for strategy to help you identify what that information might be. We will review that content, what it includes in the standard in step 3 of our workshop today. But for now, I'm going to show you our framework on this step. So as Fiona mentioned, there's a checklist in the model guidance we shared with you as a resource. And that checklist has 3 items you might want to work on in step 1. These actions help boards to build an understanding of sustainability related risks and opportunities and how this relates to the organization strategy and importantly, the role of the board. Now, these steps focus on understanding first what sort of sustainability related risks and opportunities could face the company. Second, how these risks and opportunities could then affect the company. And finally, how ready the company is to adapt to uncertainties related to these sustainability related risks and opportunities. So with all these steps we're going to discuss in our checklist today, we've also mapped them, as Fiona showed, to various resources, one of them being the guiding principles that can help you on these actions. So for this step, it's the guiding principle and strategy that is most relevant for these actions. Now, as a reminder, these principles were developed by Chapter Zero Alliance and their partners. So I'm really pleased to have with us here today Simon from the Chapter Zero Alliance to briefly introduce what the guiding principles are and then to explain that principle and strategy and how it can be used in this first step. Thanks for being with us today, Simon. Over to you.
Great, thank you, Tiff. Pleasure to be here with you all today. And yeah, it's a pleasure to introduce the principles which, as Fiona and Tiff have indicated, we co-developed with the World Economic Forum in collaboration with Deloitte. And the guiding principles for climate and nature governance address a simple reality. Boards are increasingly expected to oversee climate and nature issues with the same rigor as they do strategy, risk, and performance. The principles offer board directors clear, actionable guidance on how to embed climate governance across markets, sectors, and board structures. The principles concentrate on 4 core areas of board responsibility and are supported by 3 essential cross-cutting foundations, which provide the conditions necessary for strengthening effective climate governance. As you will see, these governance principles also align with the content areas of the ISSB, which will be outlined, and the principles, albeit distinct from the ISSB standards, can help provide board directors with key questions to guide effective governance approaches. For boards, it is not only about mitigating risk but about seizing the upside of the transition. Directors who understand climate and nature as drivers of change can position their organizations to lead in emerging markets, attract long-term investment, and build enduring stakeholder trust. Effective governance in this context, when applied with disclosure, is good business. It signals confidence, supports resilience, and equips organizations to stay competitive in a rapidly evolving environment. Today, we will look at each principle in detail and zone in on the skills and knowledge foundation in particular. And we will also share details with you of how you can access the principles and where to find further supporting information. So for this module, the first guiding principle we're going to zone in on is strategy. And this principle supports boards in aligning ambition with investment, testing the resilience of business models, and steering organizations towards growth opportunities emerging from the transition, while staying grounded in commercial reality and purpose. The board ensures material sustainability risks and opportunities are integrated into strategy and key decisions. This means climate and nature considerations guide priorities, investments, and long-term planning, and the business model is tested against future scenarios. Some key questions boards can consider here are: how well does the board and executive team understand how climate and nature factors could impact or benefit the business? And in what ways are these considerations integrated into strategy? And what changes might we need to make to our business model or operations to stay competitive as climate and nature issues evolve? And with that, I'll pass back across to Tiff to further look at this framework for understand.
Great. Thanks so much, Simon. And I think that's a very helpful tool to now already have in your toolbox. And we'll come back to that for each section of our checklist today. But let's go back to that checklist now and look at that first step. That's what we're going to focus on in today's workshop, but we encourage you to use the checklist as you continue your learning journey. Now, for the first checklist option, sorry, I moved a little bit fast there, or the action on a checklist is on understanding those sustainability related risks and opportunities. And now that can sometimes feel a little overwhelming. So it does help, we find, to start with a concrete framework and to build on from there. Now, climate is a great entry point because the ISSB standards, drawing on the well-established Task Force on Climate-Related Financial Disclosures, or TCFD framework, provide a really clear, well-defined risk and opportunity category framework that's very easy to navigate. So as you can see on this slide, climate-related opportunities can fall into 5 categories: resource efficiency, energy source, products and services, markets, and resilience. And we're going to go through what this might mean. Then there's also risks, which can come in 2 forms. They can come as transition risks, or they can come as physical risks. And again, we're going to go through these in a little bit more detail momentarily. Now, although we're going to focus today on climate as an example for you to get started on to use this framework, it is just a starting point. So many of these same categories, reputational risks, for example, market shifts, legal exposure, etc., apply equally to other sustainability topics like biodiversity, water, social issues, etc. So as you build familiarity with the climate framework, you'll find it becomes a useful thinking tool for sustainability related risks and opportunities more broadly. Now, we're going to ask you a question again here. So with that kind of quick overview of what might be these opportunities in particular, we want to know, are any of these opportunities that your company's already aware of, monitoring, and maybe even implementing? We'd like to know kind of what are the most common opportunities that we're seeing in this particular group. Now, I'm gonna only leave this open for maybe 10 seconds, so enter your options quick. Maybe just the top one, the one that comes to mind first, and then what we're gonna do is we're gonna take a look at the one that the least number of you are working on, so that we can dive into detail in that particular one with an example. But in your handout, the slides handout that you can download from our website, you're going to find examples of all of these. And those examples come from an e-learning course that Chapter Zero Alliance has online. We'll also share the link to that in the slide handout, and we can put it in the chat as well. So you can go through all examples of all of these in detail in the e-learning course from Chapter Zero Alliance. Great, so I'm going to end the poll there and look at what we have here. So you can all see now that we have a lot of different options here. A lot of you are working on resource efficiency. Now, I think that's a pretty obvious one because the cost of resources is becoming higher and higher. So we need to get a bit more efficient with using those resources. So it's good to see that a lot of you are working on that already. We also see products and services are coming. You're seeing the opportunities of offering new products, and that's really fantastic. The least common one here is resilience. So why don't we take an example from our slide deck on that? We're going to move all the way forward to the last example actually that we had here, which is one from Nespresso. But I just want to note that actually in your slide deck, there's one example that comes a couple before that, which is from a Vigna Concetoro. And that one also looks at energy source opportunities. And I would consider that also a resilience opportunity. So you might want to take a look at that as well. But this example here comes from the coffee giant Nespresso. I'm sure many of you are familiar with this company. And they've planted 10 million trees between 2014 and 2024 in the coffee farms within their supply chain. Now, they weren't just any trees. These native trees were introduced through an agroforestry approach and are complementary to the coffee plants. And the trees act as natural carbon sinks as well as compensating Nespresso's residual GHG emissions. I think what's really important from the look at of resiliency here is they, at the same time of improving the quality of coffee, also provide a habitat for local species. They improve soil health, water quality, and they support farmers to diversify their income streams. So this act of enhancing the biodiversity in the coffee plantations in their supply chain of their company also then enhances the resiliency of that supply chain. Biodiversity creates more resilient ecosystems, and it helps the coffee plantation protect themselves against both physical and transition risks related to climate change. So, speaking of risks, maybe let's go back to the risk side that we were looking at before. So, as we covered earlier, climate related risks can fall into two categories. They can be physical risks or they can be transition risks. Now, physical risks are the direct impacts of climate change on the company's assets, operations, and supply chains. These can be either acute, so that's sudden event-driven disruptions like floods, storms, or wildfires, or they can be chronic, meaning longer-term shifts such as rising sea levels or water scarcity or sustained temperature increases that gradually erode the business value. Those are physical risks. We can also have transition risks. Now, this arises from the global shift to a lower carbon economy. And this includes policy and legal changes, technological disruptions, shifting market conditions, or even reputational exposure. So, for instance, if a company is perceived to be lagging on its climate commitments, this can have a reputational impact on the company. It's also worth noting that these same two risk types apply beyond climate. As we mentioned before, this can also apply, for example, to biodiversity loss or ecosystem degradation, which can affect supply chains and operations in a very similar way. Now, physical risk tends to be a little bit more self-explanatory, and since we're a bit short on time today, we only have 90 minutes together, I'm going to take the time to dive a bit deeper into transition risks, but you can find an example of physical risks also in your slide handout. So this example of a transition risk comes from Ørsted, and I think it's one of the most compelling real-world illustrations of transition risk and what it looks like when a board and leadership team act early on enough to turn a risk into a real opportunity. So in 2006, this company Ørsted, then known as Dong Energy, and maybe some of you are aware of them. Give me a thumbs up if you've heard of Dong Energy turned into Ørsted. They were one of the most coal-intensive utilities in Europe. So fossil fuels accounted for 85% of its power and heat production, and it accounted for a third of Denmark's total national emissions. Its growth strategy then was to expand coal, oil, and gas activities further across northwestern Europe. And I didn't see any thumbs up, so maybe you're not so aware of it. So I'm glad we're sharing this with you today. The interesting thing is that senior leadership began to read the signals that were happening around to them. They saw that climate change was becoming a serious policy priority, and the EU was setting very ambitious renewable energy targets, and stakeholder concern about coal was really growing. So the board recognized that the company's core business model really faced an existential transition risk. And rather than wait for that disruption to arrive, they chose to lead that transition. So the transformation that followed meant that the company invested heavily in offshore wind, systematically closed or converted coal-fired power plants, and eventually they actually divested their oil and gas assets entirely. So by 2019, which was actually 21 years ahead of their original plan, renewables accounted already for 85% of energy generation. And carbon emissions had fallen in 2019 by 86% compared to their 2007 levels. Now, critically, this was not, achieved through the expense of financial performance. Operating profits nearly doubled over that period, with 98% of earnings now coming from renewables. And a Harvard Business Review ranking saw them as one of the top 10 business transformations of the decade globally. Now, I think here the lesson for boards is that transition risk, identified and acted upon early, does not have to be, and really simply should not be, a threat to value. It can and should be the foundation for creating value. Now, the question to ask of the company you oversee is, are we reading those signals? And are we acting on them early enough? Now, with that solid grounding, I hope, of a quick overview of sustainability related risks and opportunities and the categories and frameworks you can use to understand them, we want to share another resource you can use. So this is from the annex of the model guidance, and it helps you see kind of what questions you can ask and what best practice looks like. So in this step, we suggest starting with an open question to management, such as what are the top sustainability related risks and opportunities facing the company, industry, and supply chain? This is intentionally wide. It invites management to demonstrate their awareness of the bigger picture, not just what's happening inside the company. And then from there, you can dive deeper into follow-up questions, which we provide also in that annex. And you'll find a list of best practice in there too. So with that, I'll pass to Fiona to take us through the next step.
Great, thanks, Tiffany. So hopefully then that gives us a clearer picture of the overall sustainability landscape. So we'll now move into the next step in our process, which is align. So this step really shifts the focus inwards from understanding what risks and opportunities exist to ensuring that the company itself has the right parameters in place to manage them. And so the most relevant ISSB disclosure content to draw on here is the risk management requirements. And so there are three key actions that can help you to get started in this step. So firstly, taking a stance on materiality. So this means engaging with your management team's judgments about which sustainability related issues are financially significant enough to act on and disclose. So as a board member, you shouldn't simply accept those determinations. You should aim to satisfy yourself that they're credible and aligned with stakeholder and particularly shareholder expectations. Secondly, you need to think about setting the tone from the top. So the questions that you ask and the expectations that you signal are going to send a clear message about whether sustainability is treated as a core strategic matter or as a compliance exercise. And of course, that signal that you send through those questions matters enormously. And then thirdly, there's setting the policy framework. So making sure that the policies in place in your organization actually reflect the tone that you're setting, and that sustainability is really embedded into internal controls and processes and not just bolted on as an afterthought. And so, as with step one, here in our second step aligned, there is a guiding principle that we can anchor this step to, which is the risk and opportunity principle. So, back over to you, Simon, to help bring that principle to life.
Thank you, Fiona. Yeah, so the guiding principle, risk and opportunity. This principle assists boards in overseeing how material risks and opportunities are identified, assessed, and prioritized, supporting improved judgment under uncertainty and encouraging a shift from merely managing trade-offs to realizing advantage. Climate and nature-related risks are often systemic, interconnected, and long-term. Simultaneously, they can uncover significant opportunities for innovation, efficiency, and value creation. Here, the board is really looking at the bigger picture, overseeing the risks and opportunities and understanding how the organisation both affects and depends on climate and nature. In practice, that means identifying and assessing risks and opportunities, direct, indirect, and systemic. We note here that scenario analysis can be used to effectively explore how these might evolve over time to help guide decision making. A key question for consideration is how effectively is your firm in testing its ability to adapt and respond under different climate and nature scenarios, and how does this inform your risk appetite, the mitigations and opportunities you could pursue? And with that, I'll pass back to Fiona to look at the framework in more detail.
Great, thanks for that, Simon. So, with that principle in mind, then, let's now take a bit of a deeper look into our checklist again, and we'll focus on that first action point in particular around taking a stance on materiality determinations and have a think about what we really mean by that. So, materiality is probably one of those terms that nearly everyone in a boardroom or indeed in a corporate role has probably encountered at some point, but perhaps not always in the same way. And so that's precisely why we want to spend a little bit of a moment here to talk about that. So, as a board member, perhaps you're familiar with this term from the financial reporting perspective. And in that world, the term is relatively precise. So, there may be quantitative thresholds, perhaps informed by audit planning, which are really designed to identify misstatements in the financial statements or to define a clear risk appetite, for example. So, largely, materiality here is seen as a number that's objective, measurable, and aligned with auditor expectations. However, in sustainability reporting, materiality is a concept that can be seen a bit differently. So it's less about a particular threshold and more about relevance. So, which sustainability related risks and opportunities are most significant to the business and its prospects? And so that determination typically comes from a materiality assessment, which is a structured process drawing upon inputs from internal and external stakeholders, and of course, naturally involving considerable judgment. And so, this distinction between these two different uses of materiality matters quite significantly for boards. So, when management presents a materiality assessment for sustainability, you need to keep in mind that they're not necessarily presenting a calculation, but a set of judgments about what is most relevant to the company's role. And that's where your role as a board member is really to scrutinise those judgments. Are the right risks on the list? Are there any that are being underweighted, perhaps, or maybe some have been missed entirely? And then when we get into the materiality assessment process itself, that's where the use of the term can get a little bit more complex again, because there are actually different lenses through which you can assess materiality, and different frameworks for our disclosure purposes will use different lenses. And so the first lens is financial materiality, which is really asking what is the effect on the company? So, what sustainability related risks or opportunities could impact its cash flows, its access to capital, cost of capital over the short, medium, or long term? And then the second perspective is impact materiality. So, this is asking what is the impact of the company on the world, on the environment, on society, or the broader economy. And so when you combine both of those lenses, the effect of the company, the effect on the company and the impact of the company, that's when you then get to what's called double materiality. And it's also worth being aware that the term is used a little differently across different reporting frameworks. And so the ISSB uses materiality to specifically determine what information to disclose about sustainability related risks or opportunities. And that's a slightly narrower application than you may encounter in other frameworks, such as the European Sustainability Reporting Standards, which use the term a bit more broadly. So, overall, trying to get comfortable with these distinctions will make you much more effective as an overseer of disclosures that you're being asked to sign off on. And so the key question to keep in mind as we're moving forward on this is, has management applied the right lens, either according to the disclosure requirements that you're looking to meet or the overall objectives of your reporting and assessments? And have they applied those lenses rigorously? And really, that's the standard that you're looking to uphold. So I'm going to pass over to Tiffany now, who's going to talk us through this with an activity to look at it a little bit more practically.
Great. Thanks so much, Fiona. So let's look at accountability now in a classic financial case that I imagine you're all quite familiar with, the Lehman Brothers. Now, in the years leading up to the 2008 financial crisis, Lehman Brothers accumulated enormous exposure to subprime mortgage-backed securities and operated at a really extreme leverage. The board received financial reports and signed off on annual disclosures, but the processes management used to identify and assess risk were fundamentally flawed. Systemic interconnected risks, the kind that could trigger a cascade across global markets, were simply not captured in that methodology, and the board did not challenge whether the framework itself was fit for purpose. So when the housing market collapsed in 2008, Lehman Brothers filed for what remains to be the largest bankruptcy in US history. And then through post-crisis investigations, it was found that the board had not exercised adequate oversight of the risk identification and assessment processes that underpinned its disclosure. Now, remember, not every bank had this bankruptcy. Lehman Brothers was particularly exposed to this risk. Crucially, the risks that ultimately destroyed the firm were never surfaced as material in the company's disclosures because the methodology for identifying them was inadequate and also unchallenged by the board. So let's discuss this now. This example highlighted the risk of being overexposed to systemic risks that your risk management practices may not be taking into account. Now, let's think about what this might look like when we think about sustainability-related systemic risk, such as the impacts of climate change. Now, as many of you probably know, the impacts of climate change are expected to be wide-reaching, and science has shown that the effects of climate change will impact all organizations. However, each company's exposure to these effects will be different. So how can you make sure that you are not Lehman Brothers, that you're not overexposed to this particular type of systemic risk? Now, I invite you to share your thoughts on this with us. I already see someone said RIP Lehman. Apart from, what Lehman Brothers went through, let's look at what this might mean for you and how we make sure that as a company, we're not overexposed to particular systemic risks. Now, we have a lot of great expertise with us here today, so I'm going to see if Simon might be willing to have a conversation with me on this. Thanks, Simon. So you work with a lot of boards, so I wanted to see if you could get us moving on this discussion. I want to know from your perspective, from Chapter Zero Alliance's perspective, how you see this play out in companies and how are companies preparing themselves for the systemic risks such as climate change?
Yeah, thanks, Tiff. I think with the systemic risk angle, it's crucial that boards are engaged on this as a topic because a systemic risk is a risk which really, as an organization, you can't diversify away from. It's those risks which potentially require additional understanding of your operating environment, the supply chains, the way in which you're engaging across and your business supply chains are operating across climate and nature and the way in which it's utilizing nature services. And I think really thinking through the way in which different scenarios come into play is a really key route that boards can consider in this respect, and the way in which the organisation is conducting scenario analysis. And we've pointed towards that within our principle. And I know that Robert came back and pointed towards scenarios on one of the Q&A answers as well. And I think that's a sort of key tool there in the arsenal for boards to consider those systemic aspects of risk.
Great. Thanks so much, Simon. And I see a lot of people put in the chat analysis, but analyzing what? Those scenarios really help us think through that, what exactly we need to analyze, because it's very possible that Lehman Brothers didn't even know that this was something they should be analyzing. So it just simply wasn't being analyzed. Great. Thanks for that, Simon. Let's look at another example then. This one's an example of time horizon risk instead. So you've probably also heard of Kodak. So for most of the 20th century, Kodak was the dominant force in photography. And at its peak, it held 90% of the US film market. But digital photography completely wiped out the company. So what makes this case particularly interesting, I think, and directly relevant to what we're talking about today, is that Kodak was not blindsided by digital photography. I'm not sure how many of you know this, but Kodak actually invented digital photography. In 1975, a Kodak engineer built the first digital camera. The board and senior management were therefore well aware of this technology. It was discussed internally for many years, but because this shift from print to digital felt very distant, it was happening very slowly, and also because film was still generating extraordinary revenue for the company, and the fear of a digital disruption appeared to be still somewhere on the horizon rather than immediately at their front door, the company never fully committed to acting. The risk was always kind of just far enough that they could defer it until they couldn't anymore, and then it was too late. So by 2012, Kodak had filed for bankruptcy. And the failure here wasn't that they didn't, it wasn't blind spot like with the Lehman Brothers. It wasn't that they didn't see something. It was a failure to treat a long-term, slow-moving risk with the same urgency as the near-term ones. The time horizon created this false sense of security, and the board never pushed management to close that gap between awareness and action. So let's take a moment to think about this as well. So I invite you again to share your thoughts with us in the chat or in the Q&A. You can do anonymously in the Q&A if you wish. And we'd like to get your perspective on how we deal with the time horizon. So Simon, we talked about a scenario analysis when we're looking at systemic risk and really making sure we're covering all those blind spots. What do we do about the time horizon issue? Which here I think we don't really say in the slide what one, but climate change comes to mind for me because climate change is one of those ones that if we don't act now and start investing in now, it might be too late by the time we do.
Yeah, thanks, Tiff. I think the board are in a very strong position here to think through the longer term view, that longer term value creation, and how that weighs up against those shorter term pressures that an organization are dealing with. And I think crucially within this context, and the Kodak example is a good one, what are the tipping points or the potential tipping points? And this relates slightly to the scenarios piece. Those long-term risks potentially could very quickly become short-term risks. And I think, what does that look like in different scenarios across supply chains, across the value chains, across the ability to ensure from physical risks that may emerge, for instance, and more boards are needing to think about these things together and in a joined-up approach.
Great. Thanks, Simon. I mean, it really is the value of the board, no? Is being able to think beyond, the management really has to think of the day-to-day operations and how things work. But the board, in theory, should have that, bigger vision. But ironically, sometimes we totally miss that. Some good comments in the chat there too. Think fast, act smart. Yeah, it's always easier in hindsight, though, isn't it? Looking backwards. Know the company act or a continuous impact analysis. Great. Simon, also, you guys have a great e-learning course. That can probably be a good way that boards can start to think about the nature and the climate horizon and what that means time-wise. So we'll make sure to share that again in the chat too, and at the end it's in the resources. Anything else to share before I move on?
Just some really useful comments in the chat there, pointing towards the need for scenario analysis as well. And I think that sort of that likelihood of short term, medium term, long term. So yeah, absolutely, some interesting reflections there.
Great, thanks, Simon. I appreciate your inputs on that, and good job, everyone, brainstorming in the chat. Now, we did talk a little bit about that difference in role between the board and the management, specifically when we're talking about a time horizon. But also it comes back to a materiality assessment. And one of the most common questions we've actually heard from boards on materiality is simply, whose job is it? Kind of where does it lie? And the line between board oversight and management execution can sometimes feel quite blurry, especially on sustainability, which is a relatively new territory for some companies, but getting it right really matters. So if you step too far into execution, then the board loses its independence and its oversight ability. But if you step too far back and it fails its accountability to shareholders, then it's also not doing its job. So in the model guidance, we include in Annex 4 a practical reference that maps out exactly how boards and management's roles differ across 5 key areas of materiality. We hope this is a useful tool that you can make use of. And then to remind you, we also have that tool in the Annex 1 to start that conversation with management. So here we say you might want to ask a question like, do the materiality determinations for sustainability related information match the risk appetite that shareholders have. And then we provide additional follow-up questions and examples of best practice in that annex. So that can help, build your confidence to have this conversation with management and make sure that we're overseeing everything that needs to be seen. So we can avoid both those gaps in our systemic risk view and the time horizon risk as well. Great. So that brings us now to our third step, and I'm going to pass back to Fiona to kick us off on that.
Great. Thanks so much, Tiffany. So we're moving in now to oversee. So we thought there in a line about how to understand those different risks and opportunities and align on the board's expectations in regard to those. And now the next task really for you as a board member is to ensure that the right governance structures are in place to enable you to maintain effective oversight of those sustainability related topics. And so you may wish to draw on the disclosure content here from the ISSB perspective relating to governance when you're working through the checklist for this step. And so the three key action areas that we'll talk about in this area would be around establishing the right roles and communication channels between board and management, on strengthening the skills and competencies of the board members themselves, and then also thinking about linking executive compensation to sustainability metrics. So we'll focus in a little bit now on the middle action there around strengthening board skills and competencies. So now I think, of course, many of you have already taken a key action on this step because you're here with us today joining the workshop. So big congratulations for that, firstly. However, we wanted to also make sure that you could understand the ISSB standards themselves and the guiding principles in order to help you further enhance your skills and competencies here and to understand sustainability related financial disclosures better. So we're going to go into a few things here which can help you out on that point. So we'll start firstly now with looking at the guiding principle on this again, which I'll pass you back to Simon for.
So the guiding principle here is around oversight and responsibility, and boards are ultimately responsible for the long-term health and performance of the organisations they govern. This includes clarity on how climate and nature considerations are integrated into oversight frameworks, decision-making processes, and accountability mechanisms. Accountability for climate and nature sits with the board, not just management. The board makes sure there are clear roles in place and that everyone understands where responsibility lies. This principle also looks at whether the way people are incentivized and measured actually supports long-term thinking, so that decisions across the organisation are aligned with resilience and long-term value rather than short-term outcomes. For instance, how effectively do we integrate climate and nature considerations into our strategic oversight and decision-making processes? To what extent are climate and nature capabilities and responsibilities clearly defined, understood through the board skills matrices, allocated across our board committees and individual board members? This is a good opportunity to think about the foundational principle that, around skills and expertise, which supports the governing principles for climate and nature. The board maintains the skills, knowledge, and mindset to challenge strategy, oversee risk, and drive sustained value. It applies understanding of how shifts in climate and nature affect the organisation, recognising they present unprecedented opportunities and risks. Some questions for the board to consider when developing knowledge and skills could be: to what extent is the board collectively equipped to understand and robustly challenge relevant climate and nature-related risks and opportunities across different time horizons? And what formal processes, for example, board skills matrices, board evaluation, do we use to identify knowledge gaps, benchmark our capabilities against peers, and address blind spots through training, recruitment, or with external advisory support? And with that, I'll hand back across to Fiona to look at the checklist.
Great, thanks, Simon. I think that already highlights lots of interesting aspects to consider there as we're reviewing skills and competencies. So that gives us a bit of a baseline, really, to enhance that activity. And we'd like to build on that baseline now and think about some tools that you can find in the SSE model guidance. And that's the checklist here that can help you spot gaps in your overall board's pool of expertise and competencies. So the list we're seeing here isn't intended to be a list of every skill and expertise that each individual board member has to have, but more so used to make sure that at least each of those skills is represented by one board member. So as a collective board, you've got the right balance of competencies to be assessing these issues. And so the list here includes, of course, knowledge of the ISSB standards themselves, and also the aspect of sustainability related materiality judgments that we already talked about in our previous step. And it's also important that someone on the board has some experience in assessing resilience and thinking about forward-looking analysis. That could be perhaps from a climate perspective, ideally, but it's also a skill set that may well have been applied in other industries to other topics, for example, as well, that could be repurposed to help us in this area. And also, someone on the board will, of course, want to have an understanding of how to oversee and manage these kinds of risks and opportunities relating to sustainability. So some examples here being about climate, nature, supply chains, etc. And then finally, it will be good to have additional skills and expertise, particularly on sustainability related metrics as well, which are those things you're really using to measure your progress and understand how well you're tracking and managing these issues. And, are you making progress against the targets strategically that your organization has set? So we're going to take a moment now to dive in a little bit deeper on that first step in the process, which I've mentioned there around understanding the fundamentals of the ISSB. So it's great, of course, to have Robert here from the IFRS capacity building team who can talk us through this in a little bit more detail. So I'll hand over to Robert now, who's going to talk us through a bit of an overview there.
Yes, great. Thank you very much, Fiona. Indeed, and hello everyone, and great to be here on this session. Um, so let's talk about the standards, the IFRS standards, and let's also give you a bit of a background and context on the creation of the standards and what was the underlying need. So the ISSB was established in 2021 as a part of the IFRS Foundation, which is the independent public interest organization responsible for the governance and oversight of both the ISSB as well as the International Accounting Standards Board that develops IFRS accounting standards, which I hope many of you may already be familiar with. Of course, the IFRS Foundation and the accounting standards are a lot older, and we just recently been celebrating 25 years of the formation of the foundation. So, but we today will focus on the ISSB, and then the question which we try to answer and you to understand it will be, why was the ISSB launched? As it is, as you can see, or it is highlighted on the slide, the creation of the ISSB was very much informed by the market demands, by demand from investors, the companies and policymakers across global capital markets who essentially seek comparable and decision useful information about companies and their exposure to sustainability risks and opportunities. And to information also about how companies are managing, how they're dealing with those risks and opportunities. So this need was the underlying reason for the creation of ISSB. Another element at play was the demand for efficient reporting landscape, essentially to end so-called alphabet soup. Some maybe don't like this term, but there was a range of different voluntary initiatives, and the response or the one of the goals of the ISSB was to put them together and to make it this fragmented landscape more simple. So, as you know, the sustainability reporting isn't new and has been already a common practice also for many jurisdictions in for many years. But as I mentioned, the sustainability information was disclosed under different voluntary initiatives, and that's why they were not always presented in a consistent way, and often and they also been designed for different purposes, serving the needs of multiple different audiences, not just investor needs. So in this context, all of these demands and factors effectively contributed to the creation of the ISSB. Now, let's talk about another important aspect and feature of the ISSB standards. The standards have been created to provide a comprehensive foundation of disclosures that create a common language for sustainability information designed to meet investor needs across capital markets. And this is why you will sometimes hear the ISSB are referred to as the global baseline. So let's now try to think and to better understand what this global baseline really mean. Well, in fact, the ISSB standards have been developed and designed in such a way that it allows for layering of additional requirements, be that at jurisdiction-specific requirements or even the continued use of voluntary standards, such as those issued by the Global Reporting Initiative, or the one which is now relevant in Europe, the ESRS. So that may well be a target information needs for a broader set of stakeholders. I see now the slides are flipping, so I'm not sure who's then. We're still on the. I'm trying to come back to the.
Sorry about Robert. I was just trying to move you back to the right one, but I couldn't quite
All
remember where
good.
we were.
Oh, good. Yeah, so we're still on this slide. So now I want to talk about the importance of the global, why is it important? So it is so because in essence, this common language of sustainability information can be added onto for the other stakeholder purposes. So the concept of the multi-stakeholder reporting is really embedded in this building block approach and allows jurisdictions to build incremental requirements onto established baseline as needed. So this is also important in the context of interoperability, in that information reported under ISSB standards can also be presented with information disclosed to meet other requirements, so long as the additional information does not obscure the information reported on their ISSB standards. That's the interoperability concept and is relevant for the topic on how the standards work with the ESRS. So please do refer to the IFRS current guideline on how the standards evolve. And there's, of course, ongoing work on the simplification of the ESRS standards. So let's stay informed about the developments in this area. So in practice, how the board can act and why it's important for the boards to know, because it means that companies don't have to reinvent the wheel when it comes to sustainability reporting. In fact, companies may already be reporting information as a part of the regulatory or financial reporting that encompasses information required to be reported under ISSB standards. So in many cases, the existing processes you have in your organization, systems and governance structures that companies already have in place to support financial reporting can be leveraged to also support sustainability reporting. So these are important underlying principles or features of the standards. Let's now briefly go through what are the standards and what they cover. So at present, there are two ISSB standards, both issued in 2023, IFRS S1 and IFRS S2. IFRS S1 is the foundational standard and sets out the overarching requirements for a company to disclose information about its sustainability risks and opportunities. The S1 also sets out general requirements for the content and presentation. So, for example, it would then set out the requirements regarding the timing. So, about how the reporting is to be provided at the same time as the financial statements, and also about the location of the disclosures. So, that would specify how the reporting is to be provided as a part of the company's general purpose financial reports, such as including in company's management commentary or management report or strategy report, to name a few examples. Maybe a bit of focus here, and when talking about S1, it's also S1 is about all sustainability risks and opportunities. So it covers all the topics um, uh, um, uh, that could be social aspects or the nature or water issues. So you might also heard about recent announcement about how we're going to progress regarding the nature topic, and that would be already following the logic and the structure of the IFRS 1. You will be covered to report on these topics. So then moving to the IFRS S2, that would set the requirements specifically to disclose information about climate-related risks and opportunities. So that is to say, S2 applies to companies that, when using requirements of S1, identify the risks and opportunities related to climate change. And this last point is quite important to highlight because IFRS S2 builds from IFRS S1, and two standards need to be applied together. And just to flag, there are additional slides in your handout that provide a bit more detail about how the two standards interact with each other. So the last point I will mention here is that about the architecture of the standards, which adopts the architecture of the TCFD recommendation, which you might familiar already as well. So this is structure that is already used by companies around the world. You may have already seen this structure reflected in your company's climate disclosures, where sustainability information is reported across the core content areas, which we'll cover next on the next slide. So as you see here on the screen, the core content areas are governance, strategy, risk management, and metrics and targets. So before moving on, I just want to highlight that there are some additional slides in your handout that provide information about each one of these content areas and their related disclosure requirements. But for the purpose of today's session, as we're not going to go in detail to cover each of these content areas, I really just want to draw your attention to the overall objective of the ISSB standards, which is important to keep in mind when talking and thinking about the specific requirements of the standards and the type information that, as a board member or future board member, you'll need to be comfortable with in terms of assessing the quality and the credibility of the disclosures. So as you can see, the overarching objective of the ISSB standards is to require the disclosure information about sustainability risk and opportunities that is useful to primary users. So meaning investors in this case, in making decisions about providing resources to a company. So this objective is really important to keep in mind, because when you're thinking about the ISSB standards and the disclosure requirements more broadly, it's not about disclosing every information on every single sustainability risk and opportunity that a company could be affected. It's more about disclosing information about sustainability risk and opportunities that could reasonably be expected to affect a company's prospects. And that means a company's cash flows, access to finance, or cost of capital. This also means that once a company has identified the sustainability risk and opportunity, again, it's not about reporting every possible piece of information about that risk and opportunity. It's about the reporting information that is, again, useful to investors and their decision making. And finally, it's important also to remember that ISSB standards only require the disclosure of the information about sustainability related risk and opportunities to the extent that is material. So as Fiona has been discussing this earlier, companies use materiality as a filter to assess whether information required by ISSB standards would need to be disclosed in their particular circumstances. Another key thing here to keep in mind is when you're thinking about ISSB standards, is to remember that they are about transparency, not policy. So the standards are not about prescribing a particular governance or process or how companies should manage its sustainability risk and opportunities. Instead, it's about requiring companies to disclose specific information about the governance structures in place and information that explains management's role and involvement in overseeing sustainability risk and opportunities. So just to finish this part, it's important also to highlight here that the requirements are not telling companies how they should structure the governance. The governance structure could include the board or the specific committee or subcommittee or all of the above. Again, the ISSB standards do not prescribe a particular governance that companies need to put in place. It's all about transparency and be transparent in disclosing information about the arrangement of structures that are in place and explaining how governance works in their own organization. So it is especially important that in the context of the role of the board, who has responsibility in overseeing the ISSB-aligned reporting, that it's in essence already part of the broader corporate governance mandate. And again, there are additional slides in your handout that provide more detail about specific requirements, and hopefully this has provided you with a better sense of what the standards are and what they're trying to achieve. And with that, I will pass back to Fiona. Over to you, Fiona.
Great. Thanks so much for talking us through all of that, Robert. Hopefully that gives us there a good foundation for really understanding what the ISSB is and what the standards are designed for and how they can be used. So thanks for taking us through that. Great to see lots of questions coming in the Q&A as well. So just a reminder to make sure questions go in the Q&A in particular. If we put them in the chat, they might just get a bit lost. It's hard for us to give you a direct answer to your question. So do post those questions into the Q&A. And as a reminder, we've got some extra time at the end of the session where we're going to come back and have a discussion around some of those questions. So be sure to get any questions that you might have for us into that box, or feel free to thumbs up a particular question that you find interesting as well, and we can make sure to have a discussion about those that are perhaps the highest priority for the audience today. Okay, so now just to give us a little bit of a test really and consolidate some of what we've heard so far, I've got a quick question on the screen that I've just launched for you as a poll. So this question is just to test how well we understood that concept around different reporting topics. So let's say your company identified that there was a nature-related risk to the organization, perhaps maybe water scarcity, and that has been identified as something that could be reasonably expected to affect the company's prospects. Therefore, information about that risk and opportunity is something that would be material to disclose. So, in the absence of a specific ISSB standard on nature at present, which standard would you then use to disclose material information about this topic? Would it be IFRS S1, general disclosure requirements, IFRS S2 on climate-related disclosure? Maybe you think it's both, or perhaps you don't think either of those is right. So I'll give everyone a few more seconds to have a think and put their answer in. I'll give maybe another 5 seconds, and then let's have a look at the right answer together. Okay, I'll end the poll there because I think I see a pretty clear pattern, and it looks like lots of you know the answer here. Indeed, that's correct. It's important to be using both standards here because the S1 standard really gives us that guidance for how to understand issues and what the key aspects of information are that you should be disclosing about them once you've identified material information about a particular risk or opportunity. It's also important to take note of the fact that the IFRS S2 standard will also include relevant information here because nature, of course, is a closely connected issue to climate change. Climate change, of course, is going to be a significant driver of change and potential loss of nature. And also, of course, nature-based solutions, for example, are a part of climate mitigation too. So closely connected, and the S2 standard, therefore, is likely to be helpful to consider here. Okay, so As with all of the segments we've covered here, our checklist again will give you some further guidance here. And the annex of the model guidance gives you that overview of the different discussion topics that you consider to start talking about this issue as a board. So when we're coming back to that issue of skills and competence, we really recommend starting with a collective discussion, being as open and honest as you can in the board conversation about what skills you have already and maybe where there might be some gaps that you need to fill, either through upskilling or perhaps thinking about who you would appoint to the board when future opportunities arise and thinking about succession planning. So be sure to take a look at that as well. Okay, I'm now going to hand you back to Tiffany, who'll talk us through our final step in the framework today.
Great. Thanks, Fiona. So we're already past an hour. We're nearly at the full time of our workshop. Of course, remember we have 15 minutes of questions at the end that we've added on. So if you can stay, that would be great. This is step 4. And here we want to focus really on ensuring that the final sign off of public disclosures meets your expectations and that the final report builds confidence in those report users that sustainability related risks and opportunities are being adequately managed. Does the disclosure content that you may want to look at to help with these actions include those that communicate how judgments, uncertainties, and errors are managed, and the ISSB standards give you great guidance on what's required there. Now, the 3 actions in this step will help you to assess the story being told, the credibility of qualitative and quantitative information being shared publicly, and the processes being used to assure or validate that data. Now, for this final step, you can also draw on the guidance of the guiding principle on disclosure and transparency. And I'll pass to Simon to give you an overview of how you can use that. Thanks, Simon.
Thanks, Tiff. So the guiding principle for disclosure and transparency, this is about the board playing a key role in promoting transparency, integrity, and accountability through its disclosures, ensuring that investors and stakeholders are fairly informed. It oversees the systems and processes that support true and fair reporting on how changes in climate and nature may impact the organisation's financial performance and long-term prospects. In practice, this means the board is responsible for ensuring the accuracy, credibility, and integrity of climate and nature-related disclosures, as well as making sure that reporting is aligned with the organisation's overall strategy, its commitments, and relevant regulatory expectations. Key questions for boards to ask in this area could be: how well do we understand our responsibilities, potential liabilities, and stakeholder expectations regarding the information disclosed on climate and nature? And how effectively do our disclosure processes reflect the organisation's actual performance, position, and progress on climate and nature-related topics, including areas where progress is limited? And with that, I'll pass back over to Tiff to look at the framework in a little more detail.
Great. Thanks, Simon. So using that guiding principle, then you should be already well on your way then to enhancing the public sustainability related disclosures that you're putting your name on as the board. So for this final step, what we're going to focus on in our workshop today is the action point that aims to help you ensure that these disclosures are credible and that they meet the needs of report users, rather than introducing any doubts or concerns from the investors and shareholder community. To do that, we're going to look at some red flags to keep in mind. So we have a list of red flags here. These also appear in the model guidance. We're going to look at what each of them mean, and then we're going to go through a couple examples and see if we can apply these to real life examples. So the first is vague language. So this includes phrases like "we care about" or "we commit to," with nothing concrete behind them. Of course, the phrases themselves are okay, but we need commitments with measurable details. If there's no measurable details, I would consider this marketing rather than disclosures. The second is mismatched claims and data. So for example, a company describing itself as decarbonizing while its emission figures are actually rising with no explanation. Now, of course, emissions can rise if there's an explanation as to how you're still decarbonizing. Now, the numbers and the narrative should always tell the same story. So the third one here is incomplete risk references. So this is where the risks and opportunities identified in one part of the report don't actually connect through to another part talking about, for example, the metrics and the targets, or the financial information elsewhere of where you're investing in, for example. So credible reporting is really connected reporting. It should be a holistic story that you're talking about. The fourth one we see here is unmet or unmeasurable future commitments. So if there's targets that are announced in previous reports that then quietly disappear and we never see them again and there's no explanation of where they went, this is a red flag. What happened to that commitment? The fifth is no accountability. So if the board and management are described as overseeing sustainability, but there's no detail on how often or in what structure or what decisions were made as a result, that's a sign to the reader of a symbolic rather than substantive governance, and it'll be assumed that there is no proper oversight there. So now let's put this into practice. I'm going to show you a few short extracts, the kind of language you might actually see in a sustainability report that lands on your desk. And after each one, a quiz is going to pop up, and I'd like you to select which red flag you think applies. Now, there's often one very clear answer, but more than one might apply, which is fine. So the first extract, this one says, climate change is one of the most important issues of our time, and we are deeply committed to playing our part. As a company, we care about the environment, and we are working hard to reduce our impact. We believe that sustainability is core to our future, and we will continue to make meaningful step forwards. So, which red flags did you see there? We'll leave that up, and I'm going to come back actually to the excerpt so that you can see it there. And I'll give you 10 seconds to fill that out. Just a quick guess of what you think. So far, we have 15% of you that have answered. So I really encourage you to take a think about which one you think might be most relevant. As board members, this is going to be one of your biggest jobs, is to read a report and be able to get those red flags of, what's not lining up. Okay, 5 more seconds. 3, 2, 1, hit submit or you'll lose the chance. Great. Okay, so vague language was one of the clearest ones. And I think the most obvious red flag here was indeed vague language. So there's no targets, there's no metrics, there's no timeframes, nothing an investor could use to assess performance or to hold the company to account. Caring for something is not necessarily disclosure. So we would also say here that there's no accountability. So those of you that said that, really good job. And those that picked both, even better job. So since we have no idea how this commitment is being overseen, of course, we don't know anything about the accountability either. So I think what could be helpful now is let's look at how we could improve this text. So here we can see a slight improvement. So here we see that they've changed their wording a bit. They say now we have set a target to reduce our scope 1 and 2 greenhouse gas emissions by 30% by 2030 against a 2022 baseline. So a lot more detail here. In 2024, we reduced emissions by 8%, bringing us to a cumulative reduction of 14%, on track with our annual milestone. Progress is reviewed quarterly by a board sustainability committee, and reduction targets are linked to the remuneration of our chief operations officer. So why this works? Every claim is specific, it's measurable, there's a baseline, a target, a time frame, and a reported result. An investor can immediately assess whether the company is on track and has a clear understanding of what actions are being implemented internally to ensure success. Let's do one more example together. So this example actually spans 2 years of reporting. So in 2023, the company said that they committed to reducing scope 1 emissions by 15% by 2025. So we're a little bit more specific here. We know what we're aiming for. However, in the 2024 report, this commitment is no longer present. And all we see is that scope 1 emissions have increased by 4%. So I'd say we've got more questions than answers here. So which red flags do you see with this short extract? And I'll come back here so you can see. Great. So I'll give you 5 seconds. So answer quick. We'll make it a quick quiz. 5, 4, 3, 2, 1. Okay, you guys acted much quicker on this one. We got a really good participation in that one. Well done, everyone. Great. So I think one of the most obvious red flags for me in this one is unmet commitments, which a lot of you said. However, the highest one we see here, mismatched claims and data, definitely I would also agree with that. Since a claim was made, even if it was in the previous report, so if you choose either, I think you have a great eye. There's both the mismatch from, the previous report and this year's report, and there's a commitment that was never followed through with. So those are clear red flags. Now, let's look at how we could improve this one. Great. So here's a slight improvement. So they say, in our 2023 report, we committed to reducing Scope 1 emissions by 15% by 2025. They recognize that. Our Scope 1 emissions, however, increased by 4% in 2024, driven by a 12% increase in production volumes. Okay, we see why it's been increased. So far, the main difference here is we're being very clear about the commitment made, not hiding previously made commitments that did not become achieved. Then the extract continues, though, providing a clear and transparent and fair explanation of that increase. They say, on an emission intensity basis, we actually achieved a 7% reduction. Okay, so what they were doing was not for naught, right? They were actually moving towards something, but they actually just increased their production more than expected. So given this production increase, they say, we are revising our 2025 absolute reduction target to an intensity-based target of 15% per unit of output against our 2022 baseline. So they just adjusted the target so it was achievable and made sense with, their production plans now. They also said they've engaged their external auditors to review the revised methodology, and they remain committed to absolute reductions beyond 2025 as their production stabilizes. So why this works is their original commitment is acknowledged, the data is explained in context, and the deviation is transparently addressed. And the company sets out what happens next. That's exactly the kind of accountability boards should be insisting on, not burying a missed target, but owning it and explaining it. So great. To wrap up our final step here, a reminder to make use of the Annex 1 of the model guidance to start and expand your discussion on these topics. So for this action point, we once again suggest starting a discussion first internally with other board members to assess whether you've had the discussion amongst yourselves about what is needed. And then once you've had that discussion amongst board members asking, are there aspects of sustainability related financial disclosures that are at risk of accusation of misleading investors, then bring that to management with those follow-up questions you can see in the annex. Great. So that actually brings us to the end of the content today, and we're eager to get to the Q&A. Before we do that, I just have a quick quiz for you. You all answered this at the start. We asked you then, how would you rate your readiness to assess a report if it landed on your desk today, an ISSB-aligned report? How ready would you feel? Do you know what tools you would use? Do you know where to get started to make sure your skills are updated? Do you know where to find the learning materials you need? How ready do you feel to at least take those steps to increase your knowledge? We'd just like to see basically if you feel more ready now than you did at the start. Great. So I'm glad to see that you're all answering that question diligently. I'd like to get a few more people answer it, so I'm going to leave that poll up for a second. And meanwhile, I'm just going to let you know how you can ask your questions now. We've had a lot of really good questions in the Q&A, so thanks everyone for taking the time asking your questions. I hope you all got the answers that you needed, but we're going to discuss a few of these a little bit more now that we have so many great experts with us. To ask any new questions, you can either type them in the Q&A as you've been doing already throughout this workshop, or you can raise your hand. And if we do have time at the very end, we will let a few of you ask questions. verbally, but we'll first get to the ones that we have in the Q&A box. Great, so I'm going to show you now the results. Oh, there we go. It's being shared. So you can now see that actually you're feeling much more comfortable now as a group. So we're really glad to see that. Your journey's not over, of course. There's a lot of resources that you can use. We're going to quickly go over the resources while you start typing in your questions in the Q&A for those of you who can stick around for a Q&A session. Now, as a reminder, you can use the SSE's toolkit of ISSB related tools, which can be found through that QR code or the link that's been shared in the chat or in your slide deck. Now, also remember that the IFRS Foundation also has a Knowledge Hub, and they recently launched 4 free e-learning modules via the IFRS Sustainability Knowledge Hub to support adoption of the ISSB standards. So you can really dive deeper into all these topics if you'd like to, using those links there. Now, we also have some really great resources from Chapter 0. First of all, please remember that there's that e-learning course that we've seen a few times now that you can access on the Chapter 0 Alliance's website. And we do encourage you to join your local chapter as well. We provided another slide with a few extra resources here, but we also have with us information on your local chapter. And Ayman's here with us today. Ayman, we don't have a ton of time, but maybe if you have just 1 minute to give us an overview of how people can get in touch with you, how can they use the local chapter to their advantage, or maybe even join. Can you share a bit about that?
Thank you very much, Tiffany. It's a pleasure to be with all of you. Well, first of all, I have good news, and I have good news. The first piece of good news is that we are the local chapter. Chapter 0 Egypt is part of the Chapter 0 Alliance. We're the first in Africa and the Middle East. The 27th out of 35 Chapter 0s around the world. We have been operating in Egypt for the past 4 years. And you can get in touch with us through our programs manager, Engineer Muhammad Tahir, with his email. And you can access all the Chapter 0 Alliance resources through our website, chapter0egypt.org. The second piece of good news is that we, along with the Egyptian Stock Exchange, we have a memorandum of understanding and a cooperation agreement whereby we are working to provide training opportunities for listed companies in the stock exchange with very specific topics, and we are finalizing those training. We have the training modules, but we're finalizing the training times with the Egyptian Stock Exchange. So I take the opportunity to congratulate the new chairman of the Egyptian Stock Exchange and look forward to working with them on that, and look forward to working with you as well in the UNSSE and with the Chapter 0 Alliance and all the stakeholders involved.
Great. Thanks so much, Ayman. And please make sure everyone to make use of those resources. Ayman, if you can share also that email address in the chat, I think that'll be really helpful. Thank you so much. Now, we also have another really great resource here from the IFC. Now, we've been mapping back to the corporate governance methodology, which we've shared with you in our resources, but there's another useful resource from the IFC. It's their Beyond the Balance Sheet. And Dr. Amira, thank you so much for being with us here today. You know the region and the country so very well, being there. So can you share with us how they can make use of this great resource from the IFC?
Absolutely. Thank you, Tiff. Basically, it's the toolkit IFC developed is named Beyond the Balance Sheet. And the beauty about this toolkit is it provides you with step-by-step guidance on how to prepare comprehensive and integrated annual reports. So it goes beyond the traditional financial reporting, and it definitely touches on strategy, governance, risk management, performance that integrate material sustainability factors. So the toolkit target audience is companies, also investors, regulators, training organizations for capacity building, and also academia. What it includes? Basically, it includes an e-learning course on sustainability reporting essentials. So it is freely accessible, online, self-paced course that takes from the beginning till the end approximately 4 hours. But again, the beauty about it is that you can access directly which module you're interested in. So it offers flexible access to practical tools, real-world examples of reliable and globally consistent sustainability reports, and it is aligned with ISSB and other examples. So also there is a model annual report, and it provides like a structure aligned with the main recommendations of, again, the governance strategy, risk management, metrics and targets, and the IFRS S1 and S2. So it will help your company prepare to disclose under the new standards. Another good news is there is an annual report self-assessment tool. This smart technology tool helps your companies identify the strengths and the areas for improvement. So each section includes detailed questions and good practice guidelines to help you evaluate your report on a scale from 1, which is poor, to 5, which is excellent. The tool also provides recommendations and links to further resources for improvement to help you navigate the evolving sustainability reporting landscape. I believe it was shared with you the link to the Beyond the Balance Sheet in the chat box. Thank you.
Thanks, Amira, and thanks so much for being with us here today. Amira will remain for the Q&A, I believe. So if you have any questions for Amira from the IFC, please let us know as well. Great. So that comes to the end of the certified content. So you can use this link shared in the chat now for your feedback, for your certificate for filling out a feedback survey. And we'd love to give you your CPD certificate for joining us. You'll also get emailed that link. So if you don't catch it in the chat, don't worry. Zoom sends an email a day after the workshop. So you'll still get that link in the email from Zoom. But this is now when we start, I think, the most interesting section where you can ask your questions.